It's my pleasure to welcome to the stage Daryl Carter, who, if you're in the multifamily business, you certainly are aware of him, but let me just read a few things about him. He is a veteran of the commercial real estate industry and is the founder, chairman, and CEO of Avanath Capital Management, LLC. Mr. Carter directs the overall strategy and operations of the company, a California-based investments firm that acquires, renovates, and operates apartment properties with an emphasis on affordable and workforce communities. So that last question was second to last question was a perfect segue into what Mr. Carter is going to talk about. Since its formation in 2008, a really good year to form a company, Avanath has acquired $3.5 billion of property across 14 states in the U.S., comprising 15,000 apartment units. So big company doing a lot of affordable housing. It's vertically integrated and an SEC-registered investment advisor, an institutional fund manager. I have to say two other things. One is I was on a prep call with him yesterday or day before yesterday, and when his phone rings, hail to the victors play. So you know where he went to college. And he went to graduate school at the one place that rejected me when I applied to college, and it went back in 1976. So I still have a bit of a sore spot, but it's a very well-known and highly respected institution. You can go look it up if you want. Daryl Carter, thank you so much for joining us here today.
Thanks, Richard, and thanks, Kitty, for inviting me. I really enjoyed the remarks of Mosa. And, you know, as a Michigan Wolverine, I was going to make a joke that my friend Jim Harbaugh had instructed me to follow around the previous speakers and watch their speeches before mine. So, but anyway, a couple of comments I want to make before I get started about some of the comments just made. You know, I always find it interesting. I grew up in Detroit. And when I listen to people talk about people moving out of California, and as I drove here today from Orange County, like no one is moving anywhere. I mean, it's amazing when you grew up in Detroit in the 60s, where there was a population of 1.7 million, and I remember being stuck as a child in the car with my parents during traffic. And then by the time I learned how to drive, and there's 700,000 people there, wow, you can get around very quickly. So, you know, people that talk about people leaving California, you haven't lived in a place to see, you know, people exit like I did in the city of Detroit, which has gone from almost 2 million people to somewhere around 700,000 people. So that's what can happen. And, you know, talking about converting offices to residential, that's easy compared to converting shuttered auto plants. So, you know, context is always important. The other thing, just a quick comment about, you know, this office conversion and that, you know, people are done going to work. I personally don't believe that, and I think that's a bit overblown. You know, I don't own office buildings or stock in office companies, but you know, I think that, you know, this was something that's happened, but, you know, I do think, you know, it's interesting in San Francisco, people are really going back in the office because, you know, a lot of the AI technology requires collaboration, and I think a lot of things require more collaboration. So I think we're not going to see the same, this whole transition from office. Anyway, just to talk a little, this is my 42nd year in the business. And my last count, I've gone through 4 significant downturns, including the one that we can say that we're having today. In the early 1980s, when I started, I went through where interest rates were 20%. You know, I often tell my acquisition team, and particularly one gentleman who's probably one of my stars, and I always like to say that my first mortgage was 13.5%. I bought a condo on Lakeshore Drive. I started my career in Chicago. It was a $50,000 condo. I got a $35,000 mortgage at 13.5. And he looks at me, and I know what he's thinking, like, damn, he was really subprime. But that was where rates were, but that's the perception. Then, started my first company during the S&L, the crisis of the early 1990s and the recession that was caused by an oversupply. And so that created, lots of interesting situations. And then, of course, the global financial crisis of 2008 and of course, today. So, the ULI was here a couple of weeks ago, and there's lots of talk about, there's a little bit of doom and gloom, but I think, I tend to be an optimist, and I want to talk about what I perceive as some of the opportunities that are out there today. And every one of these cycles creates opportunities. Just a little bit about my company, Avanath. Started in 2008, and the great news, May 1st, 2008, closed our first big acquisition. It's wonderful. GP interest in 26,000 affordable apartment units, borrowed $300 million bridge loan, guaranteed 20% of it. And of course, because I knew everything was going to work perfectly, it was a one-year bridge loan that was due April 30th, 2009. First week of September, I had a handshake deal with a very large pension fund that had committed $400 million for my new company in this venture. And I remember going that Friday after, great, and we figured out the term sheet. I went to go see a game in the old Yankee Stadium. It was the last year that it was open. And I go there. I was excited to see a game at the old Yankee Stadium. Started raining, pouring. And that was just the metaphor for that day, because that weekend, Lehman Brothers, everything crashed, and then the pension fund called that following week, said every bet is off. So that first deal I did in Avanath, lost the portfolio, lost $30 million of my capital, lost $30 million of my investor capital. It's a hell of a way to start a business. So we somehow recovered. Today, we own and operate about 100 apartment communities in 15 states, which total about 16,000, 17,000 apartments. 85% of our properties are in the capital A affordable business. They are tax credit properties. They are project-based Section 8. So we serve residents who are at the 40 to 80% of AMI. And just to touch on Jamie's comment, which I thought was incredibly astute regarding new development, primarily our business model is to acquire and renovate. I think it's extremely difficult to build brand new affordable units. Our average rent across our portfolio is about $1,400 a month, which is a very affordable rent, particularly where we're focused. We are primarily focused on the two coasts, about half east of the Mississippi, half west, but we're in San Francisco, Sacramento, Seattle, LA, Orange County, San Diego County, and then a big presence from Boston to DC, and also Orlando, Chicago, Dallas, and Denver. But we're primarily, heavy presence in the coastal markets. We like those markets because the delta between affordable rents and market rents are something like 30 to 40%. We started this business because we felt that capital A affordable buildings, rent-restricted buildings, we could create long-term economic value out of those, which have been historically, the value has been extracted through tax credits and other fees and things like that. So a couple of parts of our strategy. We really focus on investing in our properties so that we maintain consistent occupancy. We sit today, our portfolio is about 98% occupied, with about 70% of our properties that operate at 100% with waiting lists. We have a property just right on the other side of the 101 freeway on Hill and Cesar Chavez that is a 120-unit property. The average rent is about $1,000 a month. It's right at the foot of Chinatown. And we probably have 3 units turnover a year. We have 300 on the waiting list. And, that is the demand today for quality, affordable rental housing. One of the things that we do is maximize cash flow by minimizing turnover. Our annual turnover is less than 15%. Most market rate properties, I was just reading one of the REITs that's listening to their conference call. They were saying they had gotten there. They were the lowest in the industry in the REIT world, and they had 40% turnover. And 40% turnover is what people tend to accept in the apartment business. The one thing we've learned about turnover, and this is really important, if people say, how do we make, when we buy apartment communities, how do we make them safer? It's one reason. If you minimize turnover, you get rid of the bad people, and people know their neighbors, it becomes safer, period. I mean, you can say security, cameras, all those things, but when you have, think about your street that you live on. If you had a 50% turnover of your neighbors, that wouldn't be a very nice street to live on. So the same thing applies. There are lots of perceptions of affordable properties, particularly those, 80% of our properties are in communities of color, primarily Black and brown. 50% of our residents are Section 8 voucher holders, and you talk to institutional investors, and there's always like Section 8, oh my God, people's heads explode. And we tell them one thing, the default rate, our rental default rate on our Section 8 portfolio is under 20 basis points. And I dropped the mic. You cannot numbers do not lie. But that's one of those things that, we have to deal with in our business, specifically the markets that we target. One of the fascinating disconnects in our country is that if you look at the big capital sources, where are they? They're the big state pension plans. They're in Albany, New York. They're in Olympia, Washington, Lansing, Michigan. These are nice cities, but they're not New York. When you look at state capitals, there's only a few of them that are located, Boston, Phoenix, and places like that. They're generally, far removed. And what you learn is, I remember going to, I will not mention the state, but, and I went to their capital, which is kind of a dump. And it was hard to get there. It was 3 hours to drive, it's a pain. And you go there, and they were like, Section 8 housing, we don't want any of that kind of stuff. And I'm like, have you looked at your mobile home park communities around here? And, but that's the perception. And I've even had where we had a CIO of a pension fund that wanted to look at one of our properties. Of all places, Loudoun County, Virginia. Loudoun County, Virginia is one of the most affluent places we're in. The median income is about $150,000, so someone at 60% of AMI makes $90,000. So they called me the day before. They said, Daryl, I'm sorry that I have to ask this, but when I go to your property tomorrow, is there any chance that I'm going to get shot? So I listened, and I said, well, I cannot comment on your personal situation. I don't know who you owe money to. I don't know if you have an ex-wife or mistress that's hostile. I said, so notwithstanding any of that, when you come to our property tomorrow at 10 o'clock on a Tuesday, it's going to be empty. So notwithstanding your personal situation, you are unlikely to be shot. But again, that's the perception that we're dealing with. And one of the things that was really transformative, it was so hard in the early years of this company to raise money. One day, my partners and I decided, well, there's got to be money. This place is hard to raise money. And so it was also, I think, 2015 or 2016, I was going through a divorce and wanted to get away. So we started looking outside the U.S., primarily Europe and Asia. And one of the interesting things we learned is that investors in many countries, specifically where we've had the most success in raising capital, that's the UK, the Netherlands, Germany, and Switzerland, they're big investors in affordable housing. And they call it over there social housing, but they believe that it's a viable asset class where they make lots of money, and they like it. And many of those countries, particularly the Netherlands, very wealthy country. They have a lot of North Sea oil revenues where they're looking to invest in the U.S. And the U.S. is still a safe haven in the world, particularly with the geopolitical issues we have. People want to invest in the U.S. So that really became our growth engine. And today, as we sit with our $4 billion portfolio, about 60% of our capital comes from outside the U.S., and specifically a lot of it from those four countries that I mentioned. So that's an overview of our company. I would say the last other points I'll make about Avanath, while we invest in the brick and mortar at our communities, and again, we are a for-profit company and we generate market returns, we believe it's very important to invest in the communities that we invest in, which means supporting our residents. We do a lot of programs with wellness. In many of the places we invest, there are not a lot of great grocery stores, things like that. So we bring farmers markets to our properties and things like that. We invest in brick and mortar, but also holistically in the communities we serve. And the last thing is we serve diverse communities, and we're very diverse as a company, and we think that's a key part of our strategy. Now, back to the current market conditions. What are the lessons learned from previous disruptions and downturns? And the first thing, every disruption, and I mentioned this previously, creates new opportunities. One of the things, just think, out of the great financial crisis came single-family rental. Now, single-family rental has been there for years, but institutional investment in that sector took off. Also, build-to-rent. These are things that came out of a downturn, meaning lots of foreclosed houses. Second thing, new capital sources emerge after a downturn. After the S&L crisis, which was in the early 90s, which was a big source of capital, we have public REITs, and that was the beginning of securitization. All that happened in the early 90s. As to my point about our experience, a lot more foreign capital has come in to the U.S. in real estate after the great financial crisis. Another thing is that technology, and again, technology after every downturn, it gets accelerated, and that will continue to transform the multifamily business. It was hard to think even 5 years ago that in the affordable housing business, particularly when we deal with about 40 different public housing authorities, that we would be able to ever lease online. 5 years ago, I said it's not possible. Well, after COVID, now 20% of our leases are done electronically because why? The housing authorities have adopted electronic inspections and things like that. We really need to continue to invest in technology to impact our processes, but also to build better, we've got to figure out ways to do new construction cheaper. The fundamentals are always in a downturn are recalibrated by changes in the capital market. Well, many investors are sitting on the sideline because of borrowing costs relative to cap rates, and I think in the previous panel, it was mentioned about negative leverage, and I think, Kitty, you mentioned this. I mean, the fact is we probably had a 10-year period between the late 80s and the late 90s where people were buying with negative leverage. I mean, there was a whole, people would buy at an 8% cap rate with 10% money. They'd figure out how to accrue and do all these things. I mean, we did that for 10 years, and I find it fascinating that, my average acquisition team member probably has 15 years experience. And, again, when interest rates have gone up, and finally one day I'm like, okay, everybody is dour. My God, there's no more 2% money. What do we do? This is, we're going to jump, but we're on the ground floor. But I mean, we're concerned. We take sharp objects out of people's hands. And finally one day I had it. And I hate to be the old guy, which I guess I am, which is why you're doing keynote speeches. So I finally came in with a chart where I charted treasuries from the day that I started in the business to today. And it was interesting that about the time of where our interest rates are and lower is only about 27% of that time period. So 27, 30%. And I said, what do you think I was doing the other 70%? Do you think, and just putting some perspective in it, I mean, there's a lot of money that's been made with higher interest rates, and I think people lose perspective. The one thing which, of course, you can't talk about in real estate, and that is the political side. People, look at, politics impact on a national basis and on a local basis. On a national basis, just to point something out, and I have a few bets, and I don't ever like to talk politics publicly, but I have a couple of prop bets with my friends that I'm betting right now with the appropriate odds that the two front runners that are running for president, that both will not be the eventual candidates. So I've put my money where my mouth is. Just to point out, in 1991, at the peak of the Gulf War, at the end of that in 1991, George H.W. Bush had the highest approval rate ever at 89%. That persisted through 1991 in the 70s, which is exceptional. And we all know what happened there. So, things can happen very, very quickly. I also believe that we're seeing shifts in local government today regarding the challenges and the need for more housing. Ironically, I have met in the last 6 weeks with 3 mayors, relatively new, in New York, LA, and Chicago, and they all are saying, how do we add more supply? And I think that, some of this is going to get translated into real action. So I am bullish politically because there is such a need, and when you look at the multifamily business today, the thing that everybody in this room should be excited about is that we still are undersupplied by 3 to 6 million units. I don't know what USC's forecast is, but someone is somewhere in there, 3 to 6 million units, which creates a great opportunity for everybody in this room. We also really need to think about, in some of the political wins and rent control and things like that, is the relationship that we as apartment providers have with the people who live in our communities. You know, we are probably apartment owners or somewhere probably behind attorneys, definitely behind used car dealers in terms of the perception of what we do, even though many in the industry, I mean, it's some extraordinary things that I know that companies have done during COVID and other time frames. But we have to get better at telling our story and also building relationships with our residents. And, you know, we approach it, every person that lives in an Avanath community is someone's home. And while we view, you know, we have spreadsheets and it's pro formas, there are actually people live there that have families, that pursue the American dream, and home is where everything starts. And the quality of what we do, people in this room to people who we serve, will impact what happens long term with the growth of our industry and the ability to add new supply. And I think that sometimes when we're looking at, you know, spikes and 10 and 20% rent increases, and just because we can doesn't mean that we should. You know, in the last 3 years, our AMI in our market, where we could have raised rents on average 11 to 12%. And we haven't. We've raised them. You know, most of our deals we pro forma at 3 to 4%. So if we raise them 7 or 8%, that's great. And, you know, so we have to keep that focus. With that, again, it's great to be here, and I will conclude and say we have a great opportunity to impact our communities with people in this room. So thank you.
How are you getting these kind of off the ground?
Well, number one, we primarily acquire and renovate. So we raise capital through a series of equity funds. But one point I'll mention is that, you know, when you look at one of the challenges we have in this country, we do not have enough public sector capital to address affordability. We've got to figure out ways, you know, to use private capital strategically. We bought almost 700 units in Baldwin Village in South Central Los Angeles that did not have rent regulations on them. But we went to the Housing Authority of the City of LA and we said, hey, if we put affordability restrictions at 80% of AMI, could we get a tax abatement? And we did, and we have put those restrictions, which amounted to a third of the residents getting restricted at 60%, a third at 80%, and then a third at market. But for our 60%, the average rents were about $1,500 a month. So a third of our residents actually got a rental decrease to $1,200. So 80% was about $1,500, $1,600. And then we have some that could be as high as $2,200, $2,300. But with that tax abatement, the tax abatement is worth about a 35% rent increase. And we're putting $50 million of renovations in. And so we've got to figure out ways that's our fourth deal that we've done. We've done one in Boston like that and two in Chicago. But we've got to find other ways of using public benefit, primarily tax abatements and things like that, or TIF increment financing or something like that.
So you do an excellent job, obviously, you know, with your tenant base. And I saw a couple people from the city floating around in the room. What can the city do to help you? First of all, what is a couple of your secret sauces? Because I know you get some better debt from some agencies. And so there's some things that help you deliver the product you're doing. What can the city and the municipalities do to help you secure more affordable housing and market rate affordable housing for capital A and little a?
Well, I would look, that's a great question, Kitty. And let me just say this, every city that we operate in, and starting with Los Angeles, and when we approached HACLA with the concept of when we bought Baldwin Village to do the tax abatement, we were prepared that we would have to close on it before we knew that. But I will tell you, they stepped up as an agency in a competitive bid process, and they were able to deliver when we closed, which was extraordinary. And I do think that most public agencies have that ability to do that. And part of it is building a relationship with them, and we were fortunate to have a relationship because we have Section 8 vouchers through HACLA and other agencies. So I think the relationship is the key thing, and also I think for public agencies in general, they don't want to be embarrassed, and they want you to be. They will come, and we've had different agencies come and look at our properties and even talk to our residents. So I think that building the relationship and seeing your approach is important.